At 7:30 in the morning on the 16th of September 1992, George Soros woke up in his Manhattan apartment and learned that his fund had made roughly $1 billion overnight. By close of business that day, the Bank of England, one of the oldest and most powerful central banks in the world, had been forced to surrender. Not to a rival government, not to a coordinated diplomatic assault, to a single private fund and the logic of its own currency peg. How does that happen? And 10 minutes from now, we'll get to the specific number, the precise interest rate figure that Norman Lamont announced on the steps of the Treasury, the one that told every currency trader alive that the game was already over. To understand Black Wednesday, you have to understand what the European exchange rate mechanism actually was, and why Britain joined it at the worst possible moment. The ERM was the precursor to the euro, a framework by which European currencies agreed to trade within tight bands against each other, anchored to the Deutschmark. Member currencies could not fall below their floor rate without the issuing central bank intervening to buy them back up. It was, in essence, a promise that governments would subordinate domestic monetary policy to exchange rate stability. Britain joined in October 1990, at the insistence of Prime Minister Margaret Thatcher's Chancellor John Major, at a central rate of 2.95 Deutschmarks to the pound, with a permitted fluctuation band of 6% either side. Critics, including the Treasury's own economists, thought the entry rate was too high. They were right. By 1992, the context had shifted catastrophically. German reunification in 1990 had required the Bundesbank, West Germany's central bank and the ERM's anchor institution, to finance the absorption of the East German economy. To prevent inflation, the Bundesbank, under its president Helmut Schlesinger, had raised German interest rates to among the highest levels in post-war German history. The German overnight lending rate sat above 9%. For Britain, this was a structural trap. The UK economy in 1992 was in recession. Unemployment had risen to nearly 3 million. The correct domestic policy response was to cut interest rates, but ERM membership meant that cutting rates would weaken sterling against the Deutschmark, potentially breaching the floor and forcing intervention. Britain was locked into German monetary conditions at precisely the moment Britain's own conditions demanded the opposite. Currency speculators noticed this. George Soros, managing the quantum fund from his offices in New York, had been building a short position against sterling for months. So had Stanley Druckenmiller, his chief portfolio manager, who would later describe the trade as the most obvious they had ever made. A currency short position works like this. You borrow a large quantity of the currency you expect to fall. You immediately sell those borrowed pounds and convert them into Deutschmarks or dollars or anything you expect to hold its value. Then you wait. If the currency falls, or in this case, if it is forced out of its peg and devalued, you buy the pounds back at the new lower rate, return them to whoever lent them to you, and keep the difference. The profit scales with the size of the position. Quantum's position against sterling, at its peak, was worth approximately $10 billion. Borrowed pounds sold short in anticipation of devaluation. What made the trade compelling was not speculation about whether Britain might devalue. It was near certainty, grounded in arithmetic. The Bank of England held foreign exchange reserves of roughly $44 billion. Its commitment under ERM rules was to buy sterling whenever the currency fell below its floor rate. To defend the floor against determined selling pressure, it would have to spend those reserves buying pounds that the market was actively dumping. Stanley Druckenmiller, in later interviews, described a conversation with Soros in the days before the attack. Druckenmiller had already identified the trade. Soros's instruction was to increase the position size dramatically, not to probe the peg, but to break it. As Druckenmiller recounted it, Soros told him, "When you know you're right, go in for the kill." This is the architecture of the modern currency attack, which Charles Kindleberger analyzed in Manius, Panics, and Crashes, and which Barry Eichengreen would later codify in his work on speculative attacks against fixed exchange rates. The peg creates the vulnerability, The reserve constraint sets the clock, and the speculator simply has to wait for the clock to run out. The decisive structural event occurred not in London, but in Frankfurt, in the weeks before Black Wednesday, and it centered on Helmut Schlesinger. The political logic of the ERM depended on an implicit bargain. Weaker currency members would maintain their parities, and the Bundesbank, as the anchor institution, would act to support them in genuine distress. If Germany cut its interest rates, the pressure on sterling would ease. The pound would not need to depreciate against the Deutschmark, because the Deutschmark itself would become less attractive to hold. Britain and other ERM members spent most of August and early September 1992 pressing Germany to cut rates. Norman Lamont, then Chancellor of the Exchequer, lobbied at Bath at the informal meeting of European finance ministers in early September. The Bundesbank offered a token cut, too small, as Lamont later made clear in his memoirs, to make any difference to the arithmetic. Schlesinger's position was constitutionally protected and economically defensible. The Bundesbank's mandate was German price stability, not European exchange rate harmony. German inflation was the Bundesbank's problem to solve. The consequences for sterling were, by the letter of German monetary law, not Schlesinger's responsibility. Then, on the 11th of September, 1992, 5 days before Black Wednesday, an interview with Schlesinger appeared in the German financial press. He was reported as suggesting that a broader realignment of ERM currencies would not be unwelcome. His words were careful, but their implication was plain. The Bundesbank was not going to sacrifice German price stability to preserve sterling's peg. Whether Schlesinger intended the remark as a signal to markets or as an honest assessment of his position is still contested by historians. What is not contested is the effect. Within 48 hours, selling pressure on sterling intensified sharply. If you found this thread of the story compelling, the way a single sentence from a central banker can detonate a currency, this is exactly the kind of investigation this channel is built for. You might consider subscribing. The 16th of September, 1992. Sterling opened under severe pressure. The pound had been trading near its ERM floor of 2.778 Deutschmarks for days. The Bank of England began intervening at market open, buying pounds with foreign reserves. But the selling was relentless. Within the first 2 hours of trading, the bank had spent an estimated £2 billion in intervention, and the pound had not recovered. At 9 o'clock in the morning, the British government announced its first extraordinary measure. The Bank of England's base rate would rise from 10% to 12%, effective immediately. A 2-point increase, announced before mid-morning. The intent was to make it expensive to borrow sterling and sell it short, to increase the cost of Soros's position, to signal that the government would do whatever it took. The market did not blink. Currency traders understood the signal, but they also understood the constraint. A 12% interest rate in a recession, with unemployment approaching 3 million, was not sustainable. Raising rates might defend the peg for a day. It could not defend it for a month. The speculators did not need sterling to fall today. They needed to maintain their positions long enough for the arithmetic to resolve. At 12%, the British government had committed to a policy it could not hold. Then came the second announcement. At approximately 2:15 in the afternoon, the Treasury announced that the base rate would rise again to 15%. 15%. In a single morning, the Bank of England had raised rates by 5 percentage points. This was, by any post-war measure, an extraordinary act of monetary desperation. And here is the number I promised you at the start of this video: 15%. That is the figure, announced on the public record, audible to every trader on every floor in every time zone, that closed the question. Because 15% in a British recession, in a mortgage market where millions of homeowners held variable rate loans, was a policy the government had perhaps 4 hours to maintain before political reality made it impossible. Norman Lamont knew it, the Treasury knew it, and Soros knew it. By 4 o'clock in the afternoon, sterling had fallen through its ERM floor and kept falling. At 7:30 that evening, Norman Lamont stood outside the Treasury on Great George Street and announced that Britain was suspending its membership of the ERM. The base rate, he added, would return to 12%. It was later reduced to 10%. The 15% rate had lasted approximately 5 hours. The Bank of England had spent an estimated £3.3 billion in reserve intervention that day. The pound had fallen anyway. The Quantum Fund's profit from the sterling position has been reported at approximately $1 billion in a single trading session, with further gains accumulating in the days that followed as sterling continued to fall. The total figure is typically cited at around $1.5 billion across the full trade. But what nobody noticed at the time, or rather what the commentary of September 1992 consistently missed, is that Soros did not break the Bank of England. The Bank of England broke itself. This distinction matters. Soros and Druckenmiller identified a structural incoherence in British monetary policy and bet against it at scale. But the mechanism of the collapse was not the size of their position. It was the ERM's own rules. The commitment to buy sterling at the floor was the commitment that exhausted the reserves. The commitment to raise rates was the commitment the government could not keep. Soros provided the pressure. The architecture provided the failure mode. Barry Eichengreen and Charles Wyplos, writing in the immediate aftermath for Brookings, were among the first academic economists to frame the 1992 ERM crisis. Sterling and the Italian lira fell on the same day, as a second-generation speculative attack, one in which the vulnerability was not a simple reserve deficit, but a self-fulfilling collapse of policy credibility. If enough traders believed the government would abandon the peg, the cost of defending it rose until abandonment became the only rational choice. The belief created the outcome. The historical record has settled into something that would have seemed impossible on the evening of the 16th of September. Black Wednesday was, by most measures, an economic liberation. The day after Britain left the ERM, the Bank of England cut interest rates. They cut them again the following month, and again after that. Freed from the obligation to defend a Deutschmark parity that the British economy could not sustain, monetary policy could finally respond to domestic conditions. Sterling fell, which made British exports competitive. The recession that had been deepening through 1992 began to ease. What followed was 15 years of nearly uninterrupted economic expansion. From 1992 through 2007, UK GDP grew in every single year. Unemployment fell steadily. The expansion was the longest recorded in British economic history. Its foundations were laid in part by the flexibility that ERM exit restored. Norman Lamont, who lost his position as Chancellor in 1993, politically destroyed by an event that proved, in retrospect, to have been exactly the right outcome, would later say that he was in office but not in power. The phrase became the epitaph for a period of British economic policy that had subordinated the domestic economy to an external constraint it could not bear. George Soros, asked about the trade in the years that followed, gave an answer that has been quoted by economic historians from Robert Skidelsky to Sebastian Mallaby. He had not set out to break the Bank of England. He had simply identified what the Bank of England's own situation had already made true. The crisis had a predetermined logic. He had followed it. The historical record has left one thing genuinely contested: whether Britain's ERM membership and its exit produced the conditions for the expansion that followed, or whether the expansion would have arrived regardless, and the ERM simply delayed it at considerable cost. Economists disagree. The Brookings papers of 1992 and 1993 disagree. What they do not disagree on is this. On the 16th of September, the British government spent £3.3 billion trying to prevent a market outcome, and the market won. That was Black Wednesday, the day a currency peg met the arithmetic that undid it. If this got you, the next episode on this channel is about the day in 1997 when the Thai baht collapsed and pulled half of Asia's banking systems into the water with it.